cryptocurrencies nowadays has become a popular discussion, especially among millennials and Generation Z, because these people who are more digital are viewing or are considering this as an investment option. Just 1 second. Yeah. Okay, sorry for the interruption. Okay, so this as an investment option or as an asset class, there are certain objections to consider it as an asset class, or somebody may not agree with it. How can it be considered as an asset class? Or somebody sometimes may not agree, especially there is the central banks all over the world sometimes may not be agreeing with to consider cryptocurrencies as a currency in that sense. So there are a lot of confusions with regard to cryptocurrency across the globe, not only with regard to accounting of cryptocurrencies, but also considering it as one of the investment options or considering it as a medium of exchange, because it is something happening in the internet, and also it is a system which is not centrally controlled, in the sense that the peers involved in the network are controlling the cryptocurrency, the entire setup of cryptocurrency, the currency production, the currency distribution, the currency management, everything is taken care of by the peers. Okay, the peers, it means that there are miners especially who are making transaction validation in the cryptocurrency network, and plus the other nodes in the network would be managing the affairs of the cryptocurrency. So I have a presentation so that if you listen to it, we can have a journey, a systematic journey, so that the communication part would be more effective. So I'm presenting is PowerPoint. So you please listen to it. Could you see it? Can you see it?
Yes, it's visible.
It's visible, right?
Yeah, yes, yes.
Yes. Yeah. Okay, visible, right?
Yes, sir, yes.
Yeah. Okay. So why do we discuss, if you ask me a question, why do we discuss about accounting of cryptocurrencies? Okay. Why? Because as I said, cryptocurrencies are gaining significant attention, especially, as I said, the Generation Z and the millennials. And it doesn't mean that others are not interested, but still these people are, as I said, more digital, and they are very much interested in transacting with it. Okay. And the corporates at Tesla, for example, the renowned company which makes EV autos, Uber is receiving cryptocurrencies, started receiving cryptocurrencies from Uberites. PayPal, Overstock Corporation is one of the largest consumer durable seller in US. Okay, these are all some of the examples. Those who are accepting cryptocurrencies as part of their trade or providing of services. Okay, and more importantly, mining, we have heard of a kind of business mining, and we all are familiar with physical mining, the way the gold is mined, the way the other minerals and metals are mined. That is quite understandable and quite familiar to us. But cryptocurrencies have brought a form of mining which we call digital mining. Okay, so there are companies, okay, which are engaged exclusively in mining process, mining of cryptocurrencies. So mining is a type of business which requires significant amount of or larger amount of investment in different infrastructures, in the sense the computational power, large computational power is required for mining. So significant amount of investment is there in this IT infrastructure, computer infrastructure. Plus, if you take the operational cost in them, especially in the form of electricity consumption, it is huge. One of the expenses for operation, in addition to the huge investment in infrastructure, this electricity consumption and its related charges are very much. So there is a line of business along with this cryptocurrencies, which are digital mining, and there are a lot of companies engaged in digital mining. So there's a need for accounting with regard to cryptocurrencies. So there can be some question, or there can be in particular a question with regard to since the blockchain is a digital ledger which accounts for cryptocurrencies, and that digital ledger has been recognized as a transparent system, which gives higher amount of security features. And the transaction validation is done using cryptography. And the chances of erasing once the transaction is made in the blockchain, it is almost negligible. And hacking the hashes or the hash once made, it is very difficult in the blockchain. So there is a question. This cryptocurrencies are accounted for or held in the blockchain, which is a superior form of keeping up ledger. Blockchain is simply a digital ledger. Then why? What is the problem with? Okay, so we will be discussing it. We will see it later. So since on the one side, the question is this: cryptocurrency are generated and kept in the network with the help of blockchain, which we call a digital ledger, or it is an account book which is digitally recording of all the transactions related to cryptocurrencies. That is one side. Okay, so before coming into the accounting of cryptocurrencies, the phrase itself can be divided into crypto and currencies. Okay, let us have a discussion on currencies. Currencies, we are very much familiar with currencies. Okay, so currencies, we were familiar or from the last several years, a fiat currency. So fiat currencies are, in the sense all of us knowing, these are currencies issued by the central banks all over the country, especially in the case of India, it is rupees issued by the Reserve Bank of India. And this fiat currency, it is considered as a legal tender. in the sense that within the geographical area wherein the circulation is permitted, and each entity, each person there would accept it for commodities and services. It is a legal tender, and it is based on trust, and the guarantee is given by the sovereign government. That is the very speciality of a fiat currency. And nowadays, in response to the decentralized digital currencies, or the so-called cryptocurrencies, okay, decentralized in the sense that there is no central agency controlling it. And now the central banks all over the world have started coming up with their own digital currencies. And these digital currencies, you remember, everybody has a feeling that suppose the Reserve Bank of India is coming up with, our government through Reserve Bank of India is coming up with a central bank controlled digital currency. Okay, in the previous budget, it was announced by 2023 March, we may be coming up with a digital currency. So there is a fundamental question whether this digital currency would be a substitute, or whether it would be having the same features that the cryptocurrencies. Why did we start thinking of digital currencies, the central banks across the world? Why? Because there was a pressure from the part of the cryptocurrencies to come up with central bank controlled digital currencies. Otherwise, as I said in the beginning, the popularity is increasing. And you may be knowing one of the Central American countries, you may be knowing El Salvador. And that country, they have replaced Bitcoin. Now their official currency, that is the only country in the world which has accepted or adopted this Bitcoin, the first cryptocurrency, as their official currency. And there are certain countries where, if you take Venezuela, where hyperinflation is there, people there are willing, or they are wishing to transact with Bitcoin, and they are not ready to transact with their official currency. And also, if you take Ukraine, where now this war is going on, and in Ukraine is one of the countries where the penetration of cryptocurrency is more, the penetration is more. And also Russia, if you take Russia is popularly known as, not popularly, it is known for, it is known as the hub of this illicit trafficking, etc., with the help of this Bitcoin and other cryptocurrencies. So the popularity in many ways, it is increasing. So there was warning from different international agencies, including IMF and so on, to the central banks all over the world to come up with their own digital currencies. But remember, if you weigh, or if you try to understand these two, the central bank digital currencies, already some countries have come up with central bank digital currencies. China is in its pilot project. It is in circulation now, and there are some other countries which have come up with central bank controlled digital currencies. But remember, if you compare the features, cryptocurrencies and central bank controlled digital currencies, it cannot be compared. Both are different. Both have the common feature is only this: both are digitally issued. its birth is in a digital, the births are in digital form. That is the only thing. And cryptocurrencies, as you said, it is a currency which really the founder of Bitcoin, Bitcoin was the first cryptocurrency, and the founder, if you check with his white paper and also some of his writings, you could understand that he was aiming a system to dismantle what is the fiat currencies or the central bank currencies all over the world. So cryptocurrencies never have the features like this, or cryptocurrencies are never intended to have a central control. It is a managing system, a currency management system, in the sense that currency protection, currency distribution, and currency management without the involvement of a central agency. And it is aimed at, it is a borderless one. There is no geographical border for this. It can be transacted across the world as it is happening in the with the help of or through internet. So, and moreover, a currency, that is a question when we examine the existence of cryptocurrencies as a currency, as per international accounting standard, or the IFRS, Indian IFRS or INTAS, okay, INTAS 7 or IAS 7, can we consider it as currencies? So the fundamental question is, if you have to consider something as currencies, it must be a medium of exchange. So how many people or how many organizations are accepting cryptocurrencies? That is a few organizations and people are transacting with or accepting cryptocurrencies. So in that sense, it cannot be considered as a currency. And as a store of value, can we consider it as a store of value? So it is one of the assets which is very popular for its volatility, in the sense that in the morning it may be a value, and in the evening or after 1 hour its value may be significantly changed. So it, as a store of value also, it is doubtful. And a unit of account, how many articles and services, goods and services across the world are priced with cryptocurrencies? It is a meager part of goods and services. So in all these sense, we cannot consider this cryptocurrencies as currencies. But remember, the very aim of the propounder was Satoshi Nakamoto. You may be knowing it, and his intention was gradually to bring cryptocurrency, this Bitcoin, as the global currency. That was his intention. And when we come to, as I said, this CBD, central bank controlled digital currencies, and also cryptocurrencies, these two are digital currencies. Okay, so what is a digital currency? In the sense that the fiat currency now we are holding is, its birth is in physical form. It is physically issued. But these currencies, the cryptocurrencies and the central bank digital currency, CBDs, these two are digital currencies in the sense that they are issued in digital form. They don't have a physical form. And the fiat currency which you are holding now, you can have a record of that fiat currencies in digital form. And using that, or based on that record, you can make transactions or do transactions online. It doesn't mean that it is a digital one. It is a digital representation of a physical asset or a physical thing or a physical currency. But remember, digital currency, its birth is in digital form. So how can you give a birth to something in a digital form? Okay, so in the case of cryptocurrency, it is happening through a process called mining. And the process by which the central banks across the world are coming up with a digital birth for their currency, it is yet to be known. It is yet to be known, not yet known, right? Because which methodology or which method are they using, that is quite not evident now. And sometimes it may be some part of the physical currency may be withdrawn, and against that part, a digital a digital creation for the withdrawn part of the physical currency may be taken care of. Okay. Then this is what exactly a digital currency. And nowadays it is very popular that, as I said, central bank controlled digital currency. So you may be in future, when today we may be discussing about accounting for cryptocurrencies, and in future we may be discussing also about accounting for this central bank digital currencies. Remember, it is almost, to the best of my knowledge, I would say that it is the digital version of our fiat currency. Then there is no question of separate accounting and all. Okay, but still that is, we have to witness in future. So it is a digital form the digital form of government-backed money. And it is conceptually, to the best of or to the available information, it is not different from the fiat money. It is different from the fiat money in that sense. It is its birth is in digital form. That's all. And one more thing, it uses the blockchain, the entire recording, the production, recording, the distribution, everything would be happening with the help of blockchain technology. That is a fundamental difference with regard to fiat currency. And when CBDCs are coming, central bank digital currencies are coming, it would be a convenient method, in the sense that nowadays the average time for sending money from India to some of the, suppose if you take US, it may be sometimes 2-3 days. Otherwise, that amount don't get credited into the receiver's account. Okay, the average time. And if you take the average cost, even international agencies like Financial Action Task Force and IMF arm, they have certified that if you transact with the cryptocurrencies, there is significant reduction in the transaction cost, a significant reduction in the transaction cost. Okay, so fast, safe, and less cost incurring transaction is possible through what I was telling you about cryptocurrencies. Cryptocurrencies, both the central bank digital currencies and also this cryptocurrencies are the underlying technology is blockchain. Both are working with blockchain. So I'm talking about the one of the features of the blockchain. So you can make transactions globally with faster amount of with fast, and also with more security features, safe, and with less cost. So it can be considered as, since both the central bank controlled digital currencies are working with blockchain technology, they are supposed to work with blockchain technology. So it would be a fast and convenient mode, especially cross-border transactions would be done with a faster speed and more safety and lesser or lower cost. And if the central bank CBDCs are offering one peculiar feature, in the sense that you can send or receive money or transact without a bank account. Not necessarily a bank account. You need to have simply a mobile equipment, wherein there will be a mechanism for receive and send, or to store the CBDCs, and you can freely send and receive into your equipment even without a bank account. And remember, Nowadays, the keeping of accounts of the fiat currencies. Suppose I open an account with one of the commercial banks, okay, and I deposit rupees 10,000 or rupees 1 lakh into my account. The responsibility for managing the upkeep, everything is lies with that particular commercial bank. They are managing my physical money on behalf of me, and it may be represented in digital form so that I can do online transactions and so on. But when CBDCs are coming, the liability of managing this currency, it would be with the central bank. In our case, it would be with the Reserve Bank of India, and commercial banks across India would be relieved of the responsibility of managing the currency. Okay, it means the currency in the sense that the CBDCs, the fiat currency may be in the previous one. If CBDCs, the liability would be shifted to the central bank because it is a central system which takes care of. Yes. So before coming into the accounting for cryptocurrencies, as I said, blockchain is the underlying technology. And I have told you when cryptocurrencies are generated and accounting for by the cryptocurrency generation process and the system, it is based on, or it is through blockchain they are managing it. And blockchain is a digital ledger, and it has many superior features. And you may ask, then why do we discuss about? As I said, it is only one part, and the other part is we are going to discuss. Before that, if you try to understand something about the blockchain, wherein the cryptocurrencies transactions are made or kept, that would give you some amount of strength in understanding more about cryptocurrencies. And when we discuss about accounting for miners, it would be more helpful if you may be knowing about what exactly mining. Okay, so we will have some discussion on blockchain, and we will have some discussion on cryptocurrency. Then we will move to the accounting of cryptocurrencies. Blockchain, as all of you may be knowing, this blockchain is simply, it is an account book, and it is an account book in digital form. Okay, and why it is called a blockchain? Because transactions are recorded in blocks. Okay, blocks which is carrying the details of the transactions. A digital block, simply you take into consideration. So I am explaining you what exactly a blockchain is. A blockchain, normally it is designed as something to be managed on a peer-to-peer basis. Okay, so I am telling you, a blockchain, it is a digital recording of transactions which is happening among 4 people. Okay, they are networked through computer nodes, and these people are using this blockchain technology for transfer of their money, for transacting using their money. So this is not a Bitcoin blockchain. This is a rupee blockchain, wherein only 4 participants are there, and they are transferring or transacting among themselves. This is a very micro one, just for understanding what exactly blockchain is. Okay, suppose this is a block, what I have shown here. That block is showing or giving you a piece of information that rupees 100, suppose you read like this. This is not the way transactions are recorded. These are just symbolic. Okay, you feel that rectangular block. Okay, and that block is containing the transaction, what exactly the transaction is. So A is having rupees 100 with it. Okay, So suppose A wants to transfer, rupees 50, or A is transferring rupees 50. Immediately another block will be added. Another block will be, because transactions are recorded in blocks in the blockchain. Okay, so suppose B is transferring 25, immediately another block would be added to the network. And if C is transferring rupees 15, another block would be added to this. Okay, and these blocks are linked together in the sense that it is chronologically linked. Okay, that chronology, that order you cannot change, because it is ordered using a hash function. And if you try to change any one information in a particular block, any piece of information in a particular block, the entire blocks would be disrupted. Okay, it would be affected. So erasing or making changes or making some manipulations in this chain is very, very difficult. So why these blocks are ordered like this? Okay, that is why it is called a block chain. Okay, and remember, when digital is something which we can have multiple use. If you make something digital, you can send it or you can use it a number of times, or you can send it to several people at a time. But remember, in the case of in the case of currencies, or in the case of rupees, okay, this cannot be done. If you have the digital equivalent of rupees 100, you cannot give that rupees 100 to 10 people or 50 people at a time. That multiple use is not possible. Blockchain technology offers this protection we normally call double spend protection, attack protection, that is given by this blockchain. That is why it is considered as superior, and this is you don't think that this is something which is happening in the internet with or with the help of internet and with some form of a simple design. No, blockchain and this cryptocurrency which came together, you must understand the kind of research, the thought process behind it is very large. It is huge. Long period of research, 20-25 years of research was there to come up with this blockchain based cryptocurrencies. And we are talking about not cryptocurrency, but talking about blockchain. And you see, what you see at the center is a record of different transactions took place among these participants. Okay, so this blockchain is called a distributed ledger. Okay, everybody or every participant in the network has a copy of all these, right? Okay, so it is called an open public ledger. It is called an open public ledger, and or it is a distributed ledger, and it is a peer-to-peer managed one. You could see that only 4 nodes are here. Okay, but I have written or I have recorded the transactions at the center. So there is a question, who is at the center? None at the center. Okay, so it is a peer-to. I didn't show the transaction validation and all here. Leave that. You can see through the next slide. Okay, so remember, nobody is at the center. It is a system which is managed on peer-to-peer. The peers would be doing the transaction validation. The transaction validation part is not included here. You understand this. This is the way a blockchain would be functioning. Now, we would be, hope all of you are with me. Hello? Hello?
Yes, sir. Hello.
Yes,
Yeah.
sir. Yes. Yes, sir.
Yeah. Yeah. Okay. Thank you. Yes. So I'm showing you a network similar to the previous one, but wherein Bitcoin's the Bitcoin BTC, Bitcoin core is transacted among the participants using blockchain technology. Okay, so this is a network for transacting Bitcoin, and there are 4 participants, and already 2 transactions have happened. The history of the previous transactions I'm not showing. Just understand that the previously 2 transactions have happened between or among the participants, and everybody in the network has a copy of it, and nobody at the center. Okay, no central agency to control it. And you must understand this from this ledger. A has transferred 50 Bitcoin to B, and B has transferred 25 Bitcoin to C. So we are going to see how another transaction is happening here. Okay, suppose B, one of the nodes or one of the participants in this Bitcoin network, okay, B wants to transfer. This is only his wish. This cannot be considered as a block. B to D 15, it's not a block. Just to give you the piece of information, I have just given there that one. It is not a block. Okay, so that piece that is showing the wish of B, or the intention of B to transfer to D 15 Bitcoins. Okay, so remember the Bitcoins are, or the cryptocurrencies are stored in wallets, crypto wallets, digital wallets. Okay, like your wallet, which is keeping your physical currency, and each wallet will have a private address and a public address. Private address like your passcode, and public address is like your bank account number. Okay, so B has by opening his wallet using his private address, he has broadcasted a transaction. He has broadcasted a transaction in this network, his intention to transfer 15 Bitcoins to D. Okay, immediately among the participants, there are certain participants, or there are some participants, we call them miners. As I said previously, the miners are why they are called miners, because they have significant computational power. They have significant computational power in the sense that computational power can be used to solve a math problem, or a computer generated or a system generated math problem. Okay, or a puzzle. You keep it as a puzzle. Okay, so why miners are keeping this much computational ability? Because the system will supply a puzzle or a math problem, and those miner who is coming up with a solution for that math problem or puzzle, for that math problem or puzzle, that miner would be given with the key to add this block, this intention of B to transfer 15B. That particular transaction would be added as a block into the blockchain. It can be done only by miners. And which miner would be doing this? That miner who is coming up with a solution for the computer generated problem, that miner would be given with the key to add this particular transaction as a block into the block. Okay, so why these miners are keeping this much computational power and engaging themselves in the mining process? Because there are some economic benefits for it. Okay, and what is the economic benefit? The economic benefit is Bitcoin. it is a Bitcoin. It is only through this, we can call these process together as transaction validation. So this transaction validation, okay, in the sense that first of all, they have to solve the key, solve the math problem, and then get the right to add a particular transaction as block into the blockchain. And the remuneration for it is, the mining process remuneration is rewarded by the system itself. The system itself will generate some Bitcoin. Some Bitcoin you don't consider, or you don't consider it as something, some number of Bitcoin, not necessarily. It as per the white paper of Bitcoin, okay, the remuneration over time may get reduced, and that is fixed. The protocol, everything is well written, well programmed, and this remuneration will be decreasing because the value of Bitcoin, as per the expectation of the founder, it may increase over time. So it is through this process, as I said, it is only through this mining process this would be this Bitcoin generation is happening. Like our fiat currencies, it is not digitally generated and stored somewhere else. No, it is happening only through this process called mining. And as soon as they get the key, this block would be added to this blockchain. So this is a way Bitcoin is generated, or cryptocurrencies are generated. There are two ways for the transaction validation. This is called proof of work mining, and there is another alternative. This is a process which consumes significant amount of enormous amount of electricity. But remember, there is another transaction validation process. We call it proof of stake, but remember, it may suffer from one of the serious issue. We call it 51% problem. Okay, leave that. We are not going into that. But before jumping into, or before discussing about accounting for cryptocurrencies, if you don't know about cryptocurrency, its generation and its accounting, okay, one part. The other part we are going to discuss. One part is this: it is safe, it is safely recorded, properly recorded. That record is there. It is the currency production, management, and distribution and management. We are going to discuss about cryptocurrencies, the other part of the cryptocurrency accounting, in the sense that, as I said, we begin with the specifications, or I have told you there are a lot of companies which are accepting across the globe. I am talking about this cryptocurrencies. Many people are transacting with cryptocurrencies, and also there are mining firms and crypto trading firms who are engaged in the trading of. So there is a question: how do accounts across the world recognize it? Can it be recognized as an asset? Or if it is recognized as an asset, in which form? In which form it can be recognized? Okay, whether it can be recognized as a financial asset, or whether it can be recognized as a monetary asset or a non-monetary asset. Okay, and how can we measure these cryptocurrencies? This is the practicing accountants are facing with such issues. Okay, so as I said, the cryptos are recorded in blockchain, so that part is over. It is, as I said, it is one side. But what about the firms which hold and transact cryptocurrencies? And remember, and we are familiar with US GAAP, okay, and international accounting standards and IFRS. Okay, but remember whether we are checking whether some standards so far, some standards are there with regard to the recognition of cryptocurrencies and measurement of cryptocurrencies and so on. So no separate standards are so far available. So how do we then, what can we do with accounting of cryptocurrencies? So what is possible for us? What we can do, we can just use some of the existing standards or current standards for recognition, measurement, presentation, and disclosure. Okay, we have to have this measurement, or we have to have a recognition of this cryptocurrencies. We have to have measurement of cryptocurrencies. We have to present it, and also we have to have some disclosure requirements with regard to presentation of this or reporting of this cryptocurrencies in the financial statement, especially with regard to companies. Okay, so there is a question. Can it be accounted as I have told you, there is no separate standards available in US GAAP or in international financial reporting standards, or as per international accounting, the previous one, international accounting standard, no separate standards for recognition and this presentation of this cryptocurrencies. So we are looking for whether is some suitable standards or adaptable standards can be had from the existing available accounting standards. So there is a question, what we are going to discuss today, can it be accounted for as cash or cash equivalents as defined in International Accounting Standard 7 or INTAS 7? Okay, and is there any possibility, or can it be accounted for as a financial asset in accordance with Indian Accounting Standard 32 or IFRS 9 or Indian Accounting Standard INTAS this 109? Or can it be accounted for as an intangible assets? Okay, we will check one by one. Can it be accounted for as an intangible asset in accordance with this IAS 38 or INTAS 38 and IAS 21? And can it be considered as an inventory? This in what context or in what circumstances these cryptocurrencies can be considered as inventories in accordance with IAS 2 or INTAS 2. So these we will discuss one by one so that we could be able to understand more about accounting of cryptos. So remember, there is no separate accounting standard so far. Okay, the US GAAP, there is one working group on cryptocurrencies, or they are on the effort, or they are on the verge to come up with some standards for this accounting of cryptocurrencies, but so far none is existing with regard to accounting of cryptocurrencies. So our first searches, our first examination is why cryptocurrencies cannot be considered as cash or cash equivalents. Okay, if as per the INTAS or 7 or IAS 7, something is to be considered as cash, it must be widely accepted medium of exchange. It must be. And we have a few organizations and few people are transacting with it. So if you apply a test whether it is considered as something which is widely accepted, nobody will agree with that. So in that sense, it cannot be considered. And moreover, it must be a legal tender if you have to consider something as cash as per IAS 7 or INTAS 7. It must be a legal tender also. It must be a legal, it must be backed by a sovereign government. Okay, and they are, these cryptocurrencies are poor store of value, as I said. Its value may be diminishing in a short span of time. So if you read this Accounting Standard 7, if you consider something as cash, it must be readily exchanged for goods and services. So that kind of a ready exchange, or a use of cryptocurrency as a ready exchange, or for goods and services across the globe is not there. Okay, and there's a question: can it be considered as a cash equivalent? Okay, it cannot be considered as a cash. We have discussed a lot. It cannot be considered as a cash because it cannot be considered as a medium of exchange which is widely accepted across the globe. Okay, and can it be considered as a cash equivalent? A cash equivalent. The IAS 7, as stated here, cash equivalent is short term. Short term in the sense that within a short span of 3 months, you have an intention to change its form. Okay, and it must be a highly liquid investment. Highly liquid investment means it must have a steady market. It must have a steady market for its conversion. Okay, and it must be convertible into known amounts of cash. And this is the last one, is a very important point with regard to cryptocurrencies, and which are subject to insignificant risk of change in value. Okay, so as per IAS 7, how can it be considered as a cash equivalent? It cannot be considered as cash equivalent because of the third point, which is it must, if something is to be considered as cash equivalent, okay, it must be subject to an insignificant risk of change in value. Cryptocurrency is something which is subject to significant change of value within a short span of time, in the sense that the daily volatility, if you take for fiat currencies, it is sometimes less than 2-3%, less than. Okay, not necessarily all currencies are volatile with this degree, but cryptocurrencies during the introductory stage, or the beginning stage, 2009, 10, 11, those periods, the cryptocurrency average volatility rate was per day was 50% plus or minus. Okay, and even now 20%, 25% change is quite common per day, or within a week, or within a short span of time. So there is significant risk associated with it. Means risk in the sense that price volatility. Okay, so in that sense, due to that, the IAS, as per International Accounting Standard 7 or INTE 7, it cannot be considered as a cash equivalent because it is subject to significant risk of its change in value. So it cannot be considered as cash equivalent. So how do you recognize, can cryptocurrencies be recognized as cash or cash equivalent? We have tested, okay, using Accounting Standard 7 or INTES, both are defining in the same way. So why cryptos cannot be considered as a financial asset or a financial instrument? Okay, so a financial instrument, we may be knowing was what is important for a financial instrument. Suppose if you take a financial instrument, it may be a financial asset for one party, and it would be a financial liability for another party. Okay, so there are two parties, at least two parties involved. But in the case of cryptocurrencies, there is no other party. You are holding cryptocurrency and nobody is guaranteeing you that it can be converted into. It may have an active market in future. You may be having, you can convert into, if the active market is existing there, it can be converted into cash. Okay, or other forms of currencies. It can be converted into other forms of currencies. So a financial asset or financial instrument has some, it cannot be considered as a debt instrument, or it cannot be considered as an equity instrument. Okay, there are no counterparties there. So as per this IFRS 9, or as per this, as I said, this International Accounting Standard 32 or International INTES 32, it cannot be considered as financial asset. Okay, so cryptocurrency, as I said, it never suits the definition of a debt security or an equity security that meet IFRS 9 or other regional standards. So it cannot be considered as a financial asset or financial instrument. So there is another question: can cryptos be considered as intangible assets? Okay, so as per INTES 38 or as per International Accounting Standard 38, what is an intangible asset? An intangible, what is an asset? So that is a basic question. Can cryptocurrencies be considered as an asset? If something is to be considered as an asset, it must satisfy two conditions. One, probable future economic benefit inflows would be there. Probable future economic benefit inflows would be there from that particular item which you consider as an asset. In the case of cryptocurrencies, you can argue that, or you can confirm that. As far as cryptocurrencies are concerned, not in the case of all cryptocurrencies, but in the case of most of the cryptocurrencies, you can see that an active market is existing with regard to cryptocurrencies. Okay, and at any time in future, it can be whatever cryptocurrencies you are holding, it can be converted into, and you can have a future economic inflow by selling it or by handing over it. Okay, and if you have to consider it as an intangible asset, it must be identifiable. And identifiability is a feature associated with an asset in the sense that it can be separated from the entity which is owning it or which is holding it. In the sense that cryptocurrencies, you can sell whatever cryptocurrencies you are having, or the company is having, or the organization is having. It can be sold off. It can be sold, or it can be given to, it can be gifted off, it can be given to somebody else, it can be transferred, it can again be bought. Okay, so it has that identifiable or separable feature is there. And it must be a non-monetary. We have checked whether it can be considered as a monetary asset. A monetary asset we have discussed about in the first case, in the case of cash. So this intangible asset, as per INTES or as per IAS 38, it must be a non-monetary asset without physical substance, and this is a digital one, and cryptocurrency have no physical substance. And the question is non-monetary asset. A monetary asset, it will have insignificant change in value or insignificant risk with regard to its exchange or the process when it is sold off. Okay, Okay, but in the case of non-monetary, if a particular asset is exposed to significant amount of volatility, then it cannot be considered as a monetary asset. So a non-monetary asset is one, it is there as per International Accounting Standard 21. One of the essential features of a non-monetary asset, it is absence of a right to receive a fixed or determinable number of unit of currency. Okay, it means that there is no guarantee that whatever is the acquired value, the cost by which you acquire, or what denominations it shows, that would not be realized when it is sold off. Thus, it can be the cryptos can be, if you check one by one, it has no physical substance. It is therefore it is an intangible asset. Okay, it is a non-monetary asset. Even though it has an active market, when you try to liquidate it, the possibility or the probability for a significant change in value is very high. So it can be considered as a non-monetary asset, and whether it can be considered as identifiable or separable. Yes, it can be considered as separable in the sense that you can keep it, you can sell it, you can gift it, you can again buy it. Okay, so it enjoys a separate entity apart from the entity or the organization which it holds. So cryptocurrency, it does not satisfy the requirements for considering it as a cash or cash equivalent. It is not satisfying the requirements as per the concerned accounting standards to consider it as a financial instrument or financial asset. But when you check with the accounting standards applicable for intangible assets, cryptos can be considered as intangible assets for recognition, valuation, and presentation, and also for disclosure. Disclosure is very important because here we were trying to, since there are no specific accounting standards for accounting of cryptocurrencies, what we would be doing, we are trying to find something or find an accounting standard from the currently available accounting standards. As I said, to record for and also to have this. So the judgments of the practicing accountants here is very important. We will see it later when we come up with the measurement of this. So the judgments of the accountants is very important. So wherever you have judgments as an accountant, it is to be very clearly reported or mentioned, because that kind of a disclosure is part of fair reporting and fair understanding of the financial statement. Okay, so measurement of this intangible asset as per this International Accounting Standard 38 or this INTAS. So it can be measured, as I said, at cost or revaluation. There can be two methods for valuation: cost model and also revaluation model. Cost model, it allows for, you can measure the cryptocurrencies at cost at the time when you acquire it, and subsequently it is measured at costless impairment losses. Okay, you leave the amortization because amortization is applicable to the assets which are having finite life, and here in the case of cryptocurrencies, as long as we can expect that market to be continued for a long period of time, therefore you can apply impairment tests in the sense that periodically, annually, not necessarily annually, or biannually, or according to certain events which are specific to the particular asset is happening, you can have valuation of this particular asset, and you can record for the revaluation losses. The gain cannot be recorded. The revaluation model, as per the intangible assets, can be carried at the revalued amount, as the name itself is suggesting. And one condition for this revaluation model, application of this revaluation model, is this: there must be an active market for the asset. So there is, to the best of the available information, there is active market for this cryptocurrencies. Okay, so normally you may be knowing, we will be applying or we will be considering the different cryptocurrencies as a class of asset. So same measurement model, if some cryptocurrencies are having active market and some other cryptocurrencies are having no active market, then you will be put in trouble to include all these. So you cannot follow this revaluation model. There you have to rely on that is one of the difficulties which may. So if a particular entity is holding this cryptocurrencies, all cryptocurrencies which are held by them are having active market, then revaluation model could be done. Okay, so how you would be accounting for the revaluation loss would be recognized in the profit and loss account. We may be knowing, all of you may be knowing about it. Okay, and revaluation increase should be recognized if the revaluation model is followed in other comprehensive income and accumulated in equity, and you have to use revaluation reserve account for this. Okay, and revaluation increase should be recognized in profit and loss account once the asset is got revalued and its value is increasing. Okay, you can place that value increase in revaluation reserve, and when its value is diminishing after that, okay, first of all the revaluation reserve be utilized and the rest may be taken to the profit and loss account. That is what is the international accounting standard suggests. Okay, and it can also be considered as inventories. As can it be considered this intangible inventory of intangible as per international accounting standard 2 or INTAS 2? Okay, if we are talking about the organization whose business model is it is held for sale in the ordinary course of business. You think about an organization which is transacting or trading in cryptocurrencies. Okay, and I have told you about mining firms which are in the process of production and sale of these cryptocurrencies, or there are some organizations which will be using this cryptocurrencies for as supplies for production process and service rendering and to engage in transactions. Okay, so in that case, this can be considered as cryptocurrencies can be considered as inventory, and it can be recognized if it is an intangible inventory. Okay, you should account for it not at a lower of the cost and net realizable value. You can go for valuation, fair value, less cost to sell. You can go for fair value accounting, less cost to sell, in the sense that the transaction cost which you may expected to face in or to pay in future may be deducted from the current fair value, and that value may be recognized as the value of inventory in the normally as per INTAS or as per IAS 2, this inventory is to be valued at cost or net realizable value, whichever is less. But in this case, in the case of inventory of intangibles, as I said, in the case of cryptocurrencies, it can be valued at its current market price, fair value, less cost to sell, provided it has an active market for this. Okay, so in a nutshell, if you look into, or if you again summarize the accounting for cryptocurrencies, you can see that the nature is consider it as intangible asset, and certain certain companies can consider it as inventory. And the US GAAP, as per US GAAP, there are certain interpretations and suggestions for investment firms who are buying and holding cryptocurrencies using investors' money along with stocks and other forms of investment, so that investment firms can go for this revaluation model and fair value accounting, and they can go for marking to the market on a daily basis as per US GAAP. And the other one, as I said, in the case of other companies, it can be treated as an intangible asset. Cost model or revaluation model can be followed. We have discussed about it. So the applicable standard is 38, or IAS 38. In the case of India, it is 38, or International Accounting Standard 38. And even in the case of intangible asset, if the revaluation model is followed, the same standard can be applied. But if you treat it as the crypto, in the case of crypto traders and mining firms, if you treat it as inventory, you can go for a valuation, fair value less cost to sell, and both gain and loss could be recorded, and INT-AS or IAS 2 would be applying. So I'm coming to the conclusion. There is across the globe, the practicing accountants are demanding this accounting standards from the respective bodies, because these people on their practice may be coming up with or confronting with many difficulties. And remember, cryptocurrencies over time may become, the accounting may become complicated. It is not so simple as you think. Okay, so with the current accounting standard, we explained in International Accounting Standard 27, 21, 32, 38, and IFRS 9. Okay, so much of judgment, as I said earlier. Okay, so much of judgment. Okay, we are using standards and making it appropriate for our context. So we have to have so many judgments, and therefore the disclosure requirement may be as per International Accounting Standard 1 and 10, the disclosure requirement may be essential to have a fair reading of the financial reports. Okay, and we have no other go, as I said. We have no other go. We have to rely on the existing or current accounting standards and find a suitable way out for accounting of cryptocurrencies. So I'm stopping. As you think, cryptocurrency is something which takes its birth in blockchain, which is a superior ledger. But remember, it's accounting for the other parties who are transacting with it, who are holding with it, or who are holding it, and also who are trading with it. They are finding it's difficult to account for it. And remember, its volatility and its non-acceptance by the sovereign governments across the globe are shooting up this issue, especially this accounting issue across the globe. Yes, thank you. Thank you very much. Yes.
Now, the session is open for discussion, and the participants can clear their queries either using chat box or by unmuting yourself.
Good afternoon, sir.
Yes.
Yes. So you have mentioned when we were talking about the currencies. You have connected cryptocurrencies with hyperinflation.
Sir, I'm not getting you. Participant, please, I'm not getting you. The question is not clear. Audibility is poor.
Sir, can
Yeah.
you hear me now?
Yes, I can hear you.
Yes, sir. Sir, you were talking about currencies. When you were talking about currencies, you mentioned the cryptocurrencies and hyperinflation. You have connected. So
Yeah.
I want to know more about that.
Yeah.
Yeah.
Okay, I didn't connect cryptocurrency and hyperinflation. What I was trying to convey you, in countries where hyperinflation is there, those countries, suppose if you take, now you can take Turkey, the inflation rate is now 36%. Right. So Venezuela, if you take the current, the inflation rate is very high. So though where inflation rate is very high, what does it mean? The purchasing power of the currency is decreasing over time. So purchasing power decrease means the store of the very function of a currency as a store of value is not there, or that currency is not performing. So the people are trying to hold some other currencies who are having not this much or that much volatility or a purchasing power decrease. So Bitcoin, with the expectation of, or cryptocurrencies, people in those countries, example Venezuela people, they are wishing to transact with the Bitcoin. So you may have a reverse question, sir. With Bitcoin is also having significant amount of volatility, but
Yes.
but still, if you look into the exchange rate, the first exchange rate, it has never gone down from that exchange rate. Yes, the volatility, daily volatility may be higher. So volatility is not towards one side, it is towards the upside and also towards the downside. So today $100, evening or $150, and day after tomorrow it would again become $100, again $170 or $200. Still, when it becomes a higher value, the purchasing power would be more. But in the case of national currencies, the inflation is a permanent, in the sense, to a larger extent, the country is experiencing inflation for the last some years. Okay, you got the idea. That is what is. Straight away, there is no connection with this hyperinflation. But in countries where hyperinflation is there, people are looking for alternatives. Cryptocurrencies are one of the alternatives there. That is what I meant. Hope you got.
Yeah. Yes, sir. Thank you.
Yeah.
Thank you, sir.
Yeah.
Thank you,
May
sir.
I know you? Whom are you?
Sir, I am Sanu Francis. I am a research scholar under BJT, sir. Dr. BJT,
Yeah,
sir.
okay.
I'm
It's
doing
okay.
my research.
Yeah.
One more question. It wouldn't sound funny, sir. I want to know, what about the theft during the transfer of or hacking in cryptocurrencies? Oh, when something happens in between the transfer of a cryptocurrency, who is
Yeah.
responsible? What about that theft?
You cannot fix up any responsibility for that kind of thing with regard to the very design of a cryptocurrency, especially Bitcoin, if we speak of, right? So there were hackings, and even I think you may be knowing one of the, you can just Google type this Mount Gox, one of the cryptocurrency exchanges in Japan. It was dealing with one of the, that time, then it was one of the largest crypto exchange dealing in Bitcoin, and their Bitcoin to the tune of 8 lakh Bitcoins. You assume what would have been, what was it, its market price? It was hacked by somebody else. Okay, and that kind of hacking may there. It is not only with this Bitcoin or cryptocurrencies. It can be done with your bank account, what you consider now as safe. It can also be done, right? It is all those happening in the internet may be subject to this. And regarding the compensation or who will take care of you if there is a hacking, in the case of Bitcoin or in the case of other cryptocurrencies, if you lose something, it is lost forever. Okay, suppose I have told you about two addresses. One is private address and the other one is public address, right? Hello?
Yes, sir.
Yeah. That private address is your passcode to enter or to operate the wallet, the digital wallet or the crypto wallet. If that private address is lost, everything is lost. Okay, you will lose the ownership. Okay, no hacking need be there. Okay, even if you forget or if you are losing that crypto address, I mean that your private address for your wallet, your ownership is lost forever. Nobody can help you. It is not a centralized one. It is a decentralized one. Yes.
Thank you, sir. Thank
But
you.
remember, the security system, everything in the blockchain is okay. That kind of in the case of Mount Gox, it had happened because it may be on account of some of the negligence from the part of the exchange with regard to its operations. Okay, the operational side negligence might be the reason for this kind of a hacking and the consequent loss of Bitcoin. Yeah.
Thank you, sir. Thank you very much.
Yeah. Okay. It's all right.
Sir, there is a question from Vishnupriya, and the question is how to measure the risk and returns in crypto finance market.
Okay. Simply, it is nothing. You may be knowing that it is a 24 hours market, right? And you can have, if you want stock market data, you can, the more frequent data you could get is daily data. Okay, but in the case of cryptocurrency market, even high frequency data is available for you. Minute by minute data you can take. And how do you compute the return? You take the prices for the, if you want to compute the return for the last 1 year, take the prices for the last 1 year. If it is a daily price, today's price minus yesterday's price will give you the daily return, and you add it up and you take its average. That would be the average daily return, and that average daily return when multiplied by the number of days of the market, or 1 plus r to the power of n minus 1 would give you the average rate of return for it. And risk, you can measure the you first compute the daily return or your minute by minute return, and that minute by minute return or daily return or weekly return, you find its standard deviation. That standard deviation would be the volatility measure or risk measure for that. It is almost same as that of whether it is crypto or some other form of asset. What exactly the frequency of the data, based on that frequency of the data, you can compute or you can express it on different terms. It can be daily, it can be weekly return, it can be monthly return, it can be annual return, and if you have daily return, you can annualize it. Okay, yes.
So the next question is from Hidayah, and the question is, can you please explain the taxation impact on cryptocurrencies?
Yeah. Taxation impact on cryptocurrencies. You must understand the ideology of cryptocurrencies. The cryptocurrencies are proposed, or cryptocurrencies are designed, or those who were propounding these cryptocurrencies. I mean, I'm talking about Bitcoin, the first one. The others are just followers. I don't think that they had the same ideology, or they are having the same ideology which Satoshi Satoshi Nakamoto, the so far known name about Bitcoin, the founder of Bitcoin. He had an ideology, and the very ideology was to dismantle the central bank. He was not believing the central banking system. So he was looking, the Satoshi Nakamoto was aiming at a global currency system, dismantling this central banking system across the world. So all the central bank and sovereign governments across the globe are objecting, or they are protesting against this great innovation. It is a great innovation, right? They are against those innovations. Why it is happening? Because this is a political risk, the risk of dismantling the national currencies, because it is working against the national or fiat currencies. Therefore, they won't allow. So taxing cryptocurrencies at a higher rate is one of the ways by which the government is protesting against it. But when you come to the practical side of taxing cryptocurrency transaction, you must remember cryptocurrency, its name is crypto, right? Normally, by its very design, who is transferring and who is receiving, it cannot be known. It is not known by their respective names. It is known by the crypto addresses. So how government or other agencies would be recognizing who is how they are going to recognize who are transacting with cryptocurrencies? That would be difficult. So there are a lot of practical difficulties, but straight away, if somebody is coming up with a disclosure that I have crypto dealings and it had a such and such profit or gain, then sometimes the government may go for. Now, even without giving a legal stand from the part of the government, whether, if you ask me a question whether it is legal in India, it is not yet legalized or illegalized in India, we would say. But they have come up with, they cannot say that it is legalized, illegal. It is illegal. If it is illegal, they have to say by which legislation it becomes an illegal one. So the government, just with a lesser amount of thought process and homework, have come up with a taxation. Its consequences we cannot say now, but remember,